I'm Martin King, property analyst at Edison Investment Research, and I'm joined today by Allan Lockhart, who is CEO of NewRiver REIT. I arranged this interview because I think NewRiver has got a very interesting story to tell in a sector that has evolved considerably in recent years. As the date approached, I was conscious of Charles Dickens and A Tale of Two Cities. It was the best of times and the worst of times, and with uncertainty swirling around the markets, what better time to discuss the opportunities and the risks? So, Allan, welcome.
Great to be here, Martin. Looking forward to it. Thank you.
Allan, for those who are less familiar with the company, perhaps we could just start with a short overview of what NewRiver is.
Well, NewRiver is a specialist retail REIT. We operate just in the UK. We're probably one of the leading retail REITs in the market. Today, we own and manage around about 2.3 billion of assets. That comprises a portfolio of shopping centres and also retail parks. And we're invested in pretty much most regions in the UK. We have around about 3,500 tenants in our portfolio. And so the increasing amount of data that we're receiving around customers is giving us an incredible insight as to what's going on with the UK consumer. Today, around about the portfolio that NewRiver directly owns, which is about 800 million of assets, just over 40% of that is now invested in London. So we have quite a significant investment into London retail. Around 20% is invested in UK retail parks, and then the balance is regional UK cities, including places like Edinburgh and Glasgow. Our other part of our business, as well as our balance sheet, is where we manage assets on behalf of investment partners, where we're providing high quality asset management services in return for fee income. And we have a range of partners, from private equity to some UK banks to local authorities, as well as a major UK institution. And that's a part of our business where we can grow our earnings in a capital light way. And again, it adds to our insights and access to data.
So, Allan, as I said, the sector has evolved a great deal in recent years. Could we just set the scene a little bit now in terms of how the market looks, occupiers and investors, and the trends you're seeing?
Sure. And I think we should probably talk about our marketplace before the war in the Middle East has erupted. But we would say our marketplace, certainly before the war, was in the best position it's been for about a decade. And we think that's really encouraging. Clearly, it starts with the UK consumer. UK consumers have been broadly pretty resilient, perhaps more resilient than financial markets had anticipated. Unemployment levels are still relatively low on an historical basis. Job vacancies are still elevated. Wage growth has been tracking higher than the CPI, which means that's supportive around rising living standards. House prices have been broadly stable, which is important for consumer confidence, because a lot of consumers' net worth is tied up in the value of their house. And consumers are sitting on excess savings, a lot of excess savings, which built up during the pandemic period. And as a result of a pretty resilient UK consumer, that is fed through to good levels of spending in the shops, whether that's in grocery, clothing, non-food. And we'd say today our occupational market's in its best position for quite some time for a variety of reasons. Retailers today are very focused around margin and margin growth, not just volume growth. They've invested in technology in terms of improvement in the supply chain, their efficiencies. We've seen the significant growth in omni-channel retailers taking market share away from pure play online operators. And of course, what that means is that the demand for retail space has been increasing over the last 3 to 4 years. And overall, we're seeing vacancies come down in shopping centres, come down in retail parks, driven by demand. And that is very, very positive, we think, for future rental growth and future valuations. As a result of a broadly resilient consumer, an improving occupational market, investor demand has spotted that, and investors are increasingly looking to acquire more retail in the market. So we're seeing that equity capital come into the market, so liquidity is rising, and that's really positive, we think, for valuations, whether that's in shopping centres or in retail parks. And also today, the credit markets are much more supportive around retail, so the availability of credit to support and partly fund acquisitions has also been improving over the last 2 years. And when you put all of that together, it's perhaps unsurprising that retail is probably last year one of the top performing commercial real estate sectors on a total return basis. And I think most sort of leading market commentators are expecting retail to outperform over the next 2 years. Of course, that was pre the war in Iran.
But that comes after quite a long period of underperformance in retail, doesn't it? Does that mean that this isn't all this isn't in pricing? But
look, retail's had gone through a period of very significant disruption, and a lot of that was in the 2010s, and it's really as a result of technology. Obviously, the internet's been around a very long time, but what the internet did in many ways was to accelerate other technological advancement, which converged together that created a significant disruption in retail. So I'm talking about things like faster broadband speed, the massive explosion in smart mobile phone technology, the huge growth in the big social media platforms, which are out and out selling platforms. All of that came together. And as a result of that, a significant amount of consumer spending went from a physical store channel to an online channel. And therefore, the demand for that reduced. And, at the end of the day, real estate's about supply and demand. If the demand falls and the supplies remain constant, that can create challenges. And we saw that. We saw, rents fall, valuations fall, investor confidence fall. But the market's adapting, and particularly having come out of the pandemic, where the cost of capital has changed, there's been more inflation in the market. It has been those retailers that have a physical store channel, and indeed an online channel, which has now been fully integrated, have been better placed to manage that sort of higher cost environment, whether that's capital or product prices, compared to the pure play online retailers. And I can show you data that shows the omni-channel retailers like Marks and Spencer's and Next and others are taking market share away from pure play online, i.e. those retailers that just have an online channel and no physical store channel. So the market is improving. It's still a market with an oversupply of space overall in UK terms, but the market will in time adapt, and that amount of oversupply of space will reduce. But the key from an investor perspective is make sure you invest in the right places where the supply-demand dynamics are very favorable for future rental growth. And what we would say to people is the best and the safest way to invest in UK retail real estate to deliver the best returns with the lowest risk profile is through a platform like NewRiver, because we've got 75 highly experienced people in our team with a tremendous amount of expertise. We know what we're doing. We operate in most regions in the UK, but most important of all, we've got incredible data that we're now applying to almost every decision that we make as an owner or a manager of a multi-tenanted retail real estate asset.
perhaps we can move on to talk in a bit more detail about NewRiver and how well you are positioned for those trends. And also, you've got a number of opportunities which, if you like, are baked into future earnings. And you've got some very defensive parts to your portfolio. So perhaps you can go into that.
Yeah, look, we think the growth potential for NewRiver is very significant. Today, we're in a very, very strong position. Back at the end of 2025, we did our first major public M&A transaction where we bought a business called Capital Regional that provided additional scale into our business. Our gross assets increased by 65% from that transaction, our net assets by 35%, and it was always going to be a very earnings accretive transaction. And you will have seen that in our half-year results, which we published in November, where our cash profits were effectively up by 31%. So, we're looking to grow, but it's growing in the right way that is going to deliver value for our shareholders. Our balance sheet's in a great place. We have relatively conservative levels of gearing. We've probably got over 100 million of cash in our bank, having just this year and our financial year, which finishes at the end of March, we've completed about 110 million of disposals. So we're in a great position to continue to hunt down the very best deals in the market that will deliver very attractive returns for our shareholders. But equally, we think our portfolio is well set to deliver consistent rental growth. With rental growth, that feeds into your earnings per share. But normally when rents rise, valuations follow. And as values rise, our LTV comes down, and it allows us to access some of our liquidity to deploy into other opportunities in the market to deliver even further earnings growth. So the business is going to be super focused around delivering the right results for our shareholders, and we think that through that we will be able to continue to grow the business, but doing so in the right way.
Allan, I know the message you're giving here is not just based on a gut feel. You've got an awful lot of data behind this. Could you just talk about that, the way you use data, what you've got, and what it's telling you?
Yeah, sure. I mean, we're really investing to ensure that we've got access to the best quality data that we can be confident around making decisions upon. But also, we're investing in our systems to be able to handle increasing quantities of data, to be able to organize that data, to be able to analyze it and present it into our decision makers in a very clear and concise way. And in many ways, as a real estate company, we are doing what the retailers have been doing for years. I think it's really interesting that last year, Tesco Clubcard celebrated its 30th birthday, and Tesco have been collecting data on their customers to be able to communicate their customers in a more personalized way and to ensure that the customers have got the right products at the right price in front of them. We're doing the same. So we're using data to help us make better decisions on a more consistent basis. Today, across our portfolio, we can see where customers come from, where they don't come from, when do they typically come, how often do they come, what is their demographic profile in terms of sort of income profiles. We can also see where customers would typically make their first purchase, where would they typically go for the second purchase and third purchase, and so on, average transaction value. And we think this data allows us to make decisions whether we buy an asset, hold, sell. It supports our leasing negotiations. It helps us in terms of how we spend our marketing budgets, and we can work out that sort of return on investment. It supports us around our capital expenditure strategy, a whole range of things, and it's definitely the way forward. And we are super confident around the quality of the data that we now have and the benefits that really flow from that, and it's definitely the future.
Allan, that's great. I know you're working very hard to get this message out there, and there's some very good material on your website for people who want to know more. And we'll put some links to this in the email that we send out so that people can go and find it for themselves.
Well, that's really kind of you, Martin. But also, we have a very active LinkedIn channel at NewRiver, and also my own channel. So anybody that wants to follow me, you're most welcome. Thank you.
Thanks very much.